Thank you. So I'm the finance guy on this panel, and let me start by saying that I don't work in public health. Obviously, is it working?
You might need to get pretty close to it.
Is this okay? Better? Okay. Tell me if you're not hearing me well. So I was saying, because I don't work in public health, but was actually trained in public health, the fact that I somehow, and never worked in that field for a day in my life, the fact that I somehow managed to claw my way back onto a panel on this topic somehow is a personal triumph for me that you don't even appreciate. So I work for a company called Swiss Re, and like every company whose name ends in re, that is a reinsurance company. I'm going to talk about something that I suspect you've heard about, which is the Pandemic Emergency Financing Facility, the PEF, P-E-F. The Pandemic Emergency Financing Facility is a World Bank initiated, implemented, and owned project that is a set of implementation guidelines, government's framework, and different sources of financing to provide surge funding to better respond to outbreaks, and that was initiated by the World Bank Group's president, Dr. Jim Kim, even before the Ebola outbreak in West Africa was fully over with. And so I'm going to talk about the transaction that is the heart of the financing for that facility, which is a market-based insurance transaction, in which I was involved in my capacity working in the insurance industry. Frankly, I have learned to assume that any information about insurance is too much for information for most people, and I'm not here to convince you otherwise, but I think we need to speak just a little bit about how this product works, and then I'm going to focus my remarks on how it contributes to the ambitions of the PEF and what is most innovative about it. And so when the World Bank approached Swiss Re and another handful of companies and said, "Can you design an insurance mechanism that would trigger and pay out early during an outbreak to provide that surge funding to better contain it?" which is one of the critical, sort of in hindsight, the lessons learned from the Ebola outbreak in West Africa, that funding was late to arrive. It became apparent that there is a class of securities that lends itself, at least in principle, to that ambition, that is called parametric insurance. And parametric insurance, as opposed to our car insurance, where you sign a policy, then you bump into somebody, and then you have to submit information to your insurance company, and you have to sort of prove what happened. They talk you out of it, and then if you're lucky, you get some money. Parametric insurance is a product where you define an objectively observable parameter called an index, and as soon as that is observed to have reached the pre-agreed threshold, it pays out. So obviously this is not insurance for you and I, this is insurance that some corporates buy for natural risks, and governments are increasingly using also to sort of stabilize their financing following natural disasters. So in other words, you would say if third-party meteorological agency A observes seismic activity B within the boundaries of administrative area C, then this pays out. Okay, so it's very quick to pay out, and it's fairly transparent. And so the World Bank's under the World Bank's guidance, this work eventually led to such a transaction whereby the World Bank, as the insured, buys $425 million of insurance against a finite list of pathogens, which includes Crimean Congo hemorrhagic fever, Lassa, filoviruses, coronaviruses. You can tell I'm not the expert on this, including Ebola. That's important to know for the story, because that was really the event that triggered it. And this risk was structured in such a way that investors can gauge, according to a model, the probability of it triggering, because the triggering threshold for each one of these is defined in terms of number of confirmed cases by WHO, confirmed deaths. There's a component of geographic spread. So, for example, for Ebola, it has to have been detected in 2 countries, not only 1, and so forth. And then the model that underpins this product basically tells the investors what is the modeled probability of that qualifying event, that triggering event happening. And when you have that type of probability, you can talk to financial markets because they say, all right, well, if you're telling me this has a probability of 5% of triggering every year, and I agree with your model, then I'm going to need a little bit of risk margin, but I'm happy to take that risk at 8%. And so this is an in-force coverage. The coverage is a 3-year term coverage. It incepted in July 2017, so we're a good year into it. Obviously, the World Bank pays premium to these risk takers, which are sophisticated, large investors who have specialized, investment units in this type of instrument and this type of security. And it's basically sitting there and waiting to be triggered. If it doesn't trigger at the end of the 3-year period, then the investors receive their principal back, and they will have received the regular coupon payments over the term of the instrument. And that will be the end of it. Now, that's enough on the product. What I want to focus my remarks on is how this complements the ambition. So the ambition of the Pandemic Emergency Financing Facility from the beginning was to secure funding before an event happens, and to have it be as transparent and as locked in, if you will, as possible. And by placing this risk in the market and paying the premium that the market requires for that, you were working with a level of sort of inflexibility, if you will, that is unprecedented in donor funding. Because now all of a sudden you know that, if so and so many cases of Ebola are reported by WHO over this rolling period and according to all the parameters that are predefined, if that happens, then the World Bank is going to receive this money. And knowing this forces them to think about, well, first of all, what are they going to do with that money? Okay, so there's all this contingency planning that has been conducted, or is actually still ongoing, I think, as part of the Pandemic Emergency Facility. In other words, how are they going to use this money? How is it going to reach? Who are the responding agents who are eligible to receive the funds? What are they going to do with it? How are you going to get it there? Do you have their bank account number? And all of this. Because the product is going to trigger and pay out probably within about 3 weeks. And that really puts the onus then on planning how you're going to use that money. The second thing that this forces you to think through is, well, what if it's not triggered? What if I don't get money, but I still have an outbreak that I want to respond to? And so you need to complement such an instrument with different sources of financing, and that's exactly what they did. So there's a donor, a more traditional, I'm going to call it, donor-funded pot of money sitting underneath the insured layer, and that was triggered for the first time by the Ebola outbreak in Western DRC that was officially declared over in August or late July, before the ongoing one, the current one, then broke out in Eastern Congo. And so the Pandemic Emergency Facility, I suspect you've heard the term, is a set of different financing sources, pre-agreed, and also pre-agreed implementation rules in the government's framework. There are people who have different, there's a PEF coordinator, and so everyone kind of, it's all waiting there and sitting. And this is as far as I understand, and certainly the first one that we've been involved in, quite a shift in emergency response and international emergency response, from waiting for something to happen and sort of having agreed on how you're going to react to it, to actually thinking it all through before it has even occurred. And I think I'm going to just leave it there. Perhaps we'll have time to field some questions on the details a little bit later. Thank you.